Hello and welcome to this month's Financial Markets Update. Well, we had a little bit of a recovery through the month of October. Equity markets actually sustained a pretty significant rally after what's been a difficult period through the September quarter. Our local equity market was up over 6%. We saw a broad recovery right across all parts of the market, but particularly the industrial sector, which was up strongly. As I said, that led to a nice rally in the ASX 200 over the course of the month. Global equities were also significantly higher, anywhere from sort of 6 to 7.5%, depending upon the part of the market. So equities had a strong rally through October. On the bond side of things, it was a little more mixed. We saw a rally in our local bond market as yields started to moderate a little bit, but global bonds were negative again for the month of October, and that was really on the back of higher rates coming through the system. We saw the US Federal Reserve increase cash rates by a further 0.75%. They were followed also by the ECB, as well as obviously the Bank of England continues to raise rates as well. And I think the interesting thing from the global perspective was the commentary by the US Federal Reserve that was really pointing to the fact that peak cycle rates actually may be higher than what the market was originally anticipating. We've got a view that Fed's going to be somewhere in the 4.5% to 5% range, but potentially could even be higher than that when we look through the cycle. Notwithstanding that, we look at sort of where cash rates are at the moment and the way central banks are starting to play that out. We do believe that the level of rate rises that we've seen through 2022, the Fed's increased the official funds rate by over 300 basis points already to date, and we've seen a significant rise, as we know, domestically. The RBA increased rates by 0.25% during October. So just the speed by which rate rises have come through 2022 and the extent of those rate rises, we just think it's going to moderate somewhat as we head into 2023. It doesn't mean that the terminal rates will be any lower. Inflationary expectations are still, certainly quite sticky when you're looking at inflation here, still over 6%. In the US, it's still north of 7.5%. In the UK, they're bouncing along double-digit inflation rate. So it's still quite significant, and in the context of that, we think cash rates have still got a way to go from here. But notwithstanding that, as I said, a nice positive month as it related to investment market performance, and that was certainly welcomed after what has been a very challenging first 9 months of the year. In the UK, we also saw the removal of Liz Truss after a failed 45 days as the UK Prime Minister, and Rishi Sunak was appointed into that role. He was obviously the previous Chancellor under Boris Johnson's government. From our perspective, we think that'll provide greater level of stability for financial markets and obviously I think a better policy framework for the UK as well, which is going to be particularly important, as I said, dealing with double-digit inflation. The Bank of England's been quite aggressive in the context of its requirement to increase rates, and Andrew Bailey's been certainly very forward in the way they've articulated that. So we expect cash rates to remain elevated in the UK and likely to go higher in order to try and crimp that inflation, but all of that facing into a very weak economic backdrop as it relates to the UK. So some real challenges there facing the UK economy, and obviously Rishi Sunak is the new PM on that front. In China, we saw the 20th Chinese Communist Party Congress. We saw Xi Jinping re-elected for a historic third term. Again, big focus on whether or not he would have a significant mandate for control, and certainly if you were looking at the 7-man Politburo, it's pretty clear that his power at this stage is showing no signs of weakening at all. The focus as we see it now for China is really how to get the economy moving through to the back end of the year into 2023, and certainly from the perspective of the current policy framework, whether it be around COVID zero policy, how they're dealing into the property crisis, and how they're really opening up to trade on a global scale. We think are really some of the key issues facing the Chinese government, and certainly, as I said, in a policy framework to get growth moving through the back end of this year into 2023. So some really important elements coming on the back of that, and I think a lot of that will come about as we head into the G20 summit in Bali in November. So all in all, an interesting month. It's great to have a positive month come through, but again, just the way that data is continuing to point to a broadening slowdown of economic activity, we're just not convinced that we're at the worst of market environments at this stage. As I said, though, we do think that central banks are going to start to moderate the speed by which they increase cash rates. We think that by and large that's going to be provide a bit more of a fillip to markets as we move forward, notwithstanding that we still see terminal rates still away from where they are at the moment, and we still haven't moved our terminal rate forecast lower. We think they potentially could be higher. So probably less frequent and less aggressive in the construct of rate rises throughout the rest of 2022 into 2023. That will provide some positive backdrop for financial market performance once said markets can start to price that in, but we still believe that it's still quite a number of challenges and ultimately a slowing growth outlook into the back end of the year into 2023. From an asset allocation perspective, we haven't made any material changes to the portfolios over the course of the month. We continue to focus on how to best manage into a downside risk environment, as well as a higher for longer inflationary environment. So real assets and alternatives continue to be our biggest overweight positions. We remain neutral on equities, continuing to favour large cap over small cap and EM on a global basis. And as I said, with a focus on really trying to protect portfolios through what we continue to believe is going to be a pretty challenging period over the next 3 to 6 months. As always, if you have any queries about the portfolios, please feel free to reach out to anyone in the team, and look forward to catching up again next month. Thanks and bye for now.